Good afternoon, everybody. It's 4 o'clock Eastern. Markets are closed. It is time for the Wookend. Gonna let folks trickle in, start adding people up here to speaker list, and give it a couple minutes as we compile everyone before we get things underway. So appreciate your patience. Gonna go silent for a second here while we gather everyone. I see Sir Jack is here. I see
Hey, party
Mr.
people.
Hey, I see Mr. Fat Aspirations, inviting him up. Let's see, got more to join. I know a few folks might be late. I know a few people are going to be leaving early, have other obligations, et cetera, et cetera. We work very diligently to try to find a time that we could get as many people as possible in here so we could have a good conversation. My expectation is that we're going to run possibly an hour and a half. My hope is to have a relatively open dialogue with the GME hedgehogs and let that go where it will for the bulk of the hour and a half, and then open it up for some Q&A for perhaps the last half hour. So we'll see how it goes. I have a pretty loose outline for how I want this to go. I'm going to leave it pretty open-ended and let people take the discussion where it will for the most part. I see Mr. Alpha Hound is here. I've also invited him up to join as a speaker. So yeah, it's 4:02. Going to give it a few more minutes. Bear with us as we compile the speaker list, and we'll get things underway shortly. And I'm trying to invite folks up to speak. If you are part of the prepared speaker group, please request. Don't know if it's just Twitter being buggy or what, but looking to add Joe, Alpha Hound, Fat Aspirations, and I'm waiting on a few others. I know Captain Hubbard might be, he's working on picking up a kid from an event, so, life.
Rod, major shout out onto the Bloomberg Odd Lots podcast. I just listened to it last night.
Oh, thank you. Yeah, it was fun. It was a lot less stressful than the last one I did with them. I literally recorded it that morning, Thursday, January 28th, while GameStop made all-time highs. I was on the call recording Odd Lot, so impossible to ever one up that. But it was
Yeah,
fun.
they
Thank
seem
you.
to like you a lot. So
Yeah, I must have paid him enough. Kidding. All right. I don't know what the deal
story
is.
that never ends.
Oops. Yeah, for real. Hey guys, so I am trying to invite you all to speak. I don't know if it's okay. There's Alpha Hound, so there's one. Fat Aspirations, are you there, sir? I'm inviting you up as well. Jeff Amazon, I see you, sir. I'm going to really wait to get started until I at least have everybody up here who I was expecting, or at least have a few more. We'll go back through a little bit of an overview in a minute once we're set.
I think that you should invite Joe up to speak, and you guys could do an informal QA about the documentary while you wait for folks. That'd be good entertainment.
I've invited Joe up several times, and he's clearly shy today, or Twitter is bugging out on us. So I would be happy to give some behind the scenes on the documentary while we wait. But you know what? I think the problem is, since this is a new venue for some folks, Jeff, Fat Aspirations, Joe, you need to be on mobile to join as a speaker. So if you joined from web, you're going to need to do it through the Twitter mobile app. So I'm thinking that was the communication issue that we're having. A lot of us
Yeah,
are
that's really bad user
new to this.
experience. I was on a Reddit Spaces yesterday. Sorry, Reddit Talk, and they have web reporting.
Yeah, look, we're going to use Twitter Spaces for this. We have plans to do quite a lot more. I'll maybe chime in a little bit on that through the conversation. YouTube is on the list, but you're right. There are definitely other platforms out there, and competition exists. And maybe Elon will make Twitter the greatest thing since sliced bread if this purchase does in fact go through. But yeah, just to reiterate, you cannot join from web. If you're on web, be sure to join through your mobile device if you're looking to join as a speaker. I see others out there. Again, I've invited everybody up. I think that I'm trying to get here as a speaker. So those of you who aren't able to and you're on web, please leave and rejoin on your mobile device. And that should get us squared away. I've got Cyanice up here as well. I see Jeff Amazon up here now. Joe is up. Great. Love that. Mr. Fat Aspirations, I know you were pinging me, so hopefully you heard me. There we go. Excellent. And there's a couple other folks. I'm not going to name their names out loud if they don't, since look, people may or may not want to get called out, that know who they are. If you want to come up here, please do. Awesome. I see Achilles there. Great. All right, it's 4:07. I want this to run about an hour and a half. We'll see where it goes. I appreciate everyone joining on Friday the 13th, spooky day. The markets were green. A nice bear market rally for those of you who think we're in a bear market. So it's great to end on a relatively modestly better mood than what's been going on the last few weeks in markets if you're a long only or mostly long investor. I'm going to go through a brief disclaimer because I have to. So I just need everyone to know that Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results, as Kathy Wood has found out. All investment decisions of an individual remain their specific responsibility of that individual. Sorry, Kathy, for the low blow. All right, great. So with the disclaimer out of the way, let me just briefly remind everyone who's joined, and thank you so much, people, for tuning into this. I'm very excited to have back together quite a few of the folks who I fondly refer to as the GME hedgehogs. Most all of us met online in 2020 as we were forced to stay in our homes and kind of came together through unique ways to really become this interested investor group that was by and large long GameStop. Saw a lot happen. It was a great experience, and it really informed my thinking and John Kim, the founder of Wook Capital's thinking, that the type of creative, passionate investor base that we felt like we were, and that led to the GMEDD.com report that we put out, was largely the work of kind of this collective who shared their own work and really kind of painted the best picture we could when we put out that GMEDD report in January of 2021. No one, I think, expected that within a couple of weeks it would surge far past our bull case price target, and the rest, of course, is history. But that experience that we all lived over 2020 really has led to this novel thesis for Wook Capital, where Wook Capital, really we endeavor to bring the world's brightest retail investing minds together to crowdsource research and relentlessly pursue the truth. And that firsthand experience informs the view that those passionate, creative, and resourceful retail investors can collaboratively better fill in the blanks missing from individual analysis. So we're looking to foster a community where all Wookiees, folks who are part of our community, can learn, grow, and achieve alpha together. And we have a long road ahead of us on the Wook side of things, but we're going to talk a little bit less about Wook today. Of course, I sent out the Inside Wook newsletter, which if you didn't subscribe, please see my pinned tweet. I have a link in the tweet thread to sign up. If you'd like to receive those newsletters, I also tweeted it out earlier today if you would like to read the newsletter. But really, the newsletter that I sent out today was intended as a little bit of background to kind of talk about where retail investing has shifted towards in this hyper digital world that we live in today. And I am going to let everyone who's up here on the speaker list kind of do a brief introduction of themselves if they wish. I know obviously several people are anonymous, and I respect that. And they may just want to say, hi, this is who I am. Before we get underway with kind of the panel type discussion, I'll let it go to Joe, since Joe, has that beautiful profile picture of himself that was published in the New York Times, and his name is actually out there in public. And then let him hand it off to Jack and so forth. Actually, Joe and then Alpha. I think let's start with the GME DD core crew, maybe that started things. So, Joe, tell us just a little bit about yourself and your investing journey to date.
Hey, thanks for setting this up, Rod. So, a lot of you guys probably know my work more as GMEDD.com's daily postings. I send out all the tweets. I write a lot of the articles on the site. I work with two individuals named Chris Silvestro and another girl named Jenna. We put together all the hirings and we find all the latest GameStop job listings and try and make everything more transparent. So this was never something I could have anticipated happening over a year ago. I originally reached out to Rod because I saw him and AlphaHound were putting together this website and putting together this research report. I didn't really know anyone else who was involved at this point. So I reached out to him and I said, hey, this website kind of stinks. The idea is great. The fact that there could be this website where people can learn more about the company and read this research report. But I don't know if anyone's going to take it seriously if it looks like how it does. So we quickly refreshed the website, made it a lot prettier, put together a logo, put together some more posts. And yeah, I mean, it blew up. And that's how I got to know all these people. That's how it's turned into what it is today. And definitely give a lot of thanks to Rod. And I guess I'll pass it on to AlphaHound now. He was one of the OGs here, so I'll let him introduce himself.
Sure. So I'm the one, I guess, that originally put together the really crappy site that Joe was just, he beautied it up in a big way that I could not have foreseen when we first started. So I've known Rod for a long time, probably like 15, 16 years or something.
Ninth grade, yeah.
Yeah, a long time. So, we've talked stocks for years, right? Like probably since we were teenagers. We've had a bunch of other plays in the past that have turned out good, poorly. GameStop, I think, is something that Rod originally pitched me back in 2017. And I thought, like, you're crazy. There's no way there's value there. And the big trade back then, right, was to go short physical retailers and to go long whatever the digital equivalent was. So, he was right, but way early. When he originally pitched GameStop back in, I think it was like August 2020, right, Ryan Cohen had just bought in. The story was much different. The value was a lot clearer. And we just started talking more about it. We eventually built a website, and the community just blew up in a way that, I don't think anyone who was in for the value in 2020 necessarily thought it would become what it eventually did. So,
Well
Rod,
said.
who should go next?
Yeah, John, why don't you briefly? I know, John is John's working on getting more comfortable with being a public speaker. He's been very much behind the scenes, and John, of course, is my boss and is the founder of Wook Capital. John, just give us a very brief, intro I'm not going to force you to say anything you don't feel comfortable saying, but yeah, I mean, John and I met, before he goes off, John and I met online. He reached out to me in 2020, and I couldn't tell you how many hours and hours and hours into the late nights he and I would spend talking and just discussing our thinking around GameStop. And he made a comment at one point in late 2020, like, yeah, if things go to plan, maybe we'll set up an investment fund. And I was like, yeah, okay, buddy. Lo and behold, fast forward a year and a half, and here we are. So, John.
Thanks, Rod. Thanks, Rod. Yeah, I mean, it really is crazy to think about how all this played out and the position that we're sitting here today. But more importantly, I love that we're finally all back together in one place to discuss what really went down and some of the details regarding the whole saga. Because, yeah, I mean, as you said, none of this could have happened alone. And I think people should hear on how people offer different value at really whole every step of the way. So, yeah, thanks for hosting this, Rod.
Thanks, John. I'm going to turn it then. We've got a lot of awesome folks who I've met as well through this whole process. Let's start outside of the Reddit and Discord world. Dimitri, I appreciate you joining. I've loved reading your work about GameStop in 2020, and yeah, obviously it was crazy. I met your brother in the Tampa suburbs. We went and saw the opening of the film that you and I were in, and Joe was in, and it just coincidentally was that I saw your brother there on opening night.
Yeah, that was crazy. Hi guys. It was really interesting how this whole, I don't know if we should call it movement, right? Because it wasn't really organized, but it's crazy, and it was really cool for me, at least, to find out more about people behind the internet handles or whatever through the movie, by watching the movie. And as you said, Rod, you ran into my brother in the movie theater, which is a weird coincidence.
Small world. Thanks, Dimitri. Yeah, so definitely, I know I'm talking a lot here. I want to get through these intros so we can get a good conversation going. Sir Jack, the one who missed the fireworks of January, but who was certainly fun along the way as part of this community. Please introduce yourself.
I was dancing and celebrating for everyone. The thesis was right and history was made. Hi guys, I'm just your knight in sticky armor. Hey, I'm still profitable. I ended up at $8 million. Eventually, took the leisurely route, swing trading a bunch of whole different meme stocks throughout 2021, versus the rocket ship that is GMB. But yeah, just glad to be here.
Awesome. Mr. Jeff Amazon X, could you please introduce yourself, sir? Glad to have you on.
Hey, thanks for having me on, Rod. I'm working on something right now, so I'll probably speak more later.
Okay, sounds good. Fat Aspirations, sir. Thank you for joining.
Hi, thanks for having me. I only know folks here through the internet, so I've never met anyone here in person. But we all got connected with Jimmy way back when. I think I saw Jeff Amazon's post back in September 8th. My first post on Wall Street Bets was like September 14th. And I got it was just a simple, innocuous sort of like, hey, there's some cheap calls in this thing. And then I started digging a lot deeper into it. And I think I wrote over 100 pages worth of ridiculous research on this extremely asymmetric trade that I hope we'll get again at some point in the future. And if markets continue heading down, we probably will get more opportunities like this again. But I think my story is that I have been a non-active investor for the most of my life, and was motivated to learn a lot more about markets and investing and options and mechanics and all of the stuff I wrote about in my posts. Due to basically one bad investment decision that then said, I got to fix this, and ended up doing okay. I think yeah, that's my story. This is an interesting market. It's going to be difficult, much more difficult in the next year than it has been in the last couple of years. So I think a lot of people are going to kind of be questioning whether or not their existing strategies will continue to work, and they probably should. But I'll leave that later to later discussion. That's me.
Awesome. Yeah, definitely a lot to discuss. Achilles, sir, please introduce yourself.
Hey guys, Achilles. I kind of fell into this on accident, the GameStop stuff, and a friend just mentioned that the the leaps were when the stock was trading at $4, leaps were less than $1 for about a year out. So bought some for fun, and then as it started going up, it's like, hey, maybe I should look into this, and got pretty involved in Reddit, and then met you, Rod, and things kind of progressed from there. At this point, I'm doing day trading kind of full time with some of most of the GameStop nest egg just being fully invested for the long term. That's led to a bit of a difficult month, but the day trading's been pretty good, so it's kind of writing it out. I think that's about it.
Awesome. And lastly, here up on the speaker list, Mr. Cyanice. Those of you who were in the Wall Street Bets community may remember some of his work, and really appreciate you joining, sir.
Thanks, Rod. I first got wind of GME by reading about Jonathan Prather's series on Seeking Alpha. I had really the perfect timing in the middle of August, right before Ryan Cohen bought in. And then I wrote something on Wall Street Bets under one of my alts. I don't think really that many people noticed it. I'm not as good of a writer as Jeff Amazon is. And then after that, I met a lot of this gang. And then at one point, I felt I should create a survey because such a big part of investing is the social aspect. And one of the main influencers, or influencing factors, I should say, is social proof. So I came out with 3 surveys. Maybe some of you participated in that. And I can attest that all these people on this call, the speakers, they're all whales because they told me how many shares they had. And eventually, I had to stop those surveys, not of my own volition, but because the moderators felt like it wasn't appropriate or they wanted to limit their liability. But I'm happy, again, to join with the rest of the gang and kind of have a reunion of sorts.
Awesome. I see one last gentleman, I think, jumping in, I assume this is Mr. Sneaker Sorcerer, as we know him in the interwebs. Sneakerbot user, is that you? Okay, well, they dropped. All right, great. So we did intros. Folks, look, I want to leave some time at the end for Q&A. I do see some folks who were part of this OG group that haven't yet jumped up to be a speaker. Please do, if if you're one of the OGs and you have a different username on here, please just DM me or ping me somewhere else, and I'll be happy to bring you up. Otherwise, I'm going to leave it to this speaker group for now and get things underway. So look, as you heard, there's obviously a huge array of experiences in this speaker group. I've known Alpha since I was a teenager. I've known others here since just late 2020. But one of the things that I know I found extraordinary, and that John found extraordinary, and that has led to Wook Capital, is the idea that these diverse groups of people, whether you're a lawyer, an actuary, an analyst, or whatever, like you're across the entire spectrum of professional background, and investing may just be something that you do as a hobby or as a secondary interest. Obviously, Achilles now noted that he's using this as sort of a full-time gig, and that's awesome. But there's clearly a massive range of experiences and insights that people bring to bear. And I would kind of open it up to the floor, because we all saw that, I think, firsthand. A lot of us were participants in the Roaring Kitty streams on YouTube very early on, when it was only a few dozen of us. I know Dimitri, of course, was on Seeking Alpha a lot, and in the comment section of Seeking Alpha. But I guess I would pose a question to the group, like, what are some of the ways that you experienced unique insight into how individuals can offer diverse value? And I'll share one that I remember seeing, which was, we were in one of the Roaring Kitty chats, and one of the participants was very familiar with shareholder activism. And they brought up the point that when Ryan Cohen filed his 13D, the lawyer that he had hired was a well-renowned activist lawyer, and it lended more credibility to the idea that he was very serious with what he was doing, and this wasn't just some spur of the moment thing. So like, that little nugget of information is the type of example I'm thinking of. So I'll kind of open it up to the group. What are some of the unique, interesting nuggets of information that you found, and kind of like, how do individual investors offer diverse value to investing knowledge?
Hey, Ron, I got a story, and unfortunately, I gotta duck out in a little bit. But actually, one of my favorite subreddits that I found is called VTARDS, VITARDS, and it's kind of around a lot of value plays, because we got some industry folks from like the steel industry and from the shipping industry who do these really in-depth, authentic, transparent, narratives and stories of just kind of what's going on, especially in the last year with the whole supply chain issues around steel and shipping. I mean, I think it just comes off much more authentically. It's not coming off from mainstream media. It's not being done by trading analysts who maybe cares more about getting new clients or trying to get a promotion or something like that, right? Like, these people are just working their day jobs, either at a steel mill or owning their own kind of a small business in the steel industry, and they're just reporting like what's going on, like what's happening to the contracts, what they're hearing from their partners in Asia. So I think having that authentic peer-to-peer source of information in the industry was really, really helpful. And Cleveland Cliff's CLF was my most profitable trade, my most consistently profitable trade. I think I entered and exited it like 6 different times, and each time I made a huge profit because I just knew the thesis so well, and like, it was just very reliable.
Yeah, it's. I just wanted to add to that. So I remember we had, conversations. Obviously, for me, it was mostly in comment sections to Justin's articles or to my articles. And that aside, there was, I think in the movie, Justin said it was like cotton candy, where everybody contributed and it kind of all stuck together. But I remember, to me, what sticks out, one thing is when Justin uncovered the Microsoft deal, which was kind of buried as one of bullet points to the press release, and not many people caught on to that. And there were some dismissive people saying, well, that doesn't mean anything. So he actually reached out to investor IR of the company to confirm it, and he reported about that. And the other thing was that just sticks out to me is CPT Hubbard wrote some really good write-ups on Reddit, I think. And in one of them, for example, he analyzed the letter that Ryan Cohen sent to the board, and his analysis made it clear that it was written, what was the purpose of this letter, and it was definitely written not by him just to vent at the company, but by lawyers to achieve specific goals. So that was great.
Yeah, so just to add to that, I'm looking at my emails. I sent Eric Cerny, GameStop Investor Relations, an email on Sunday, October 11th at 2:05 in the morning, asking him about the Microsoft deal. And, he responded basically affirming what you were just saying, that it's not like this is something every retailer has, that the quote was, what we can say is we will receive an undisclosed portion of the downstream revenue from any device that we bring into the Xbox ecosystem. And he noted that there might be confusion from the fact there's a time frame associated with the all access. But you're right, a lot of analysts, professional sell-side analysts, right, they poo-pooed it. And the scuttlebutt I got from an insider that I knew who was friends with someone who was at Melvin Capital was they thought it was a nothing burger.
Yeah.
So look, again, this is just a good example of getting A, digging deeper, and B, having a wide breadth of people to put that cotton candy together.
Yeah, just to go back to, and I don't want to monopolize all the time, but just go back to the title of this Twitter space, the power of retail investors, right? Because we have the skin in the game ultimately, whereas sell-side analysts don't. They work for salary, they frequently do a lazy job, and they will not dig into details the way we did, I think.
I think I'll jump in here and say, for me, the big impact of GME, besides monetary impact, was I used to be a long-standing believer in the efficient markets hypothesis, which argues that markets are efficient, leaving no room to make excess profits by investing, since everything is already fairly and accurately priced. That's the hypothesis. And there's like two forms of this. There's the strong form, which is all information, public and private, and the weak form, which says all public information. Well, GME was a case where for months, and I do mean months, like we talked about this, among ourselves, in our chat groups and on Reddit, we talked about this for months, that GME was so wrongly priced that it was just an unbelievable setup. And for that to exist for so long just means that the efficient market hypothesis is not as strong as people thought it was. Tied to this is retail has gotten a lot more sophisticated. We've gotten a lot more access to tools and data than we've had in the past. And furthermore, we have a lot more forums to share our research. So retail is essentially an extremely powerful discovery tool and socialization tool. And so I think the power is right now is retail has the ability to seek out these complete mispricings in the market and socialize them among other retail investors. Generally, this happens not on the mega caps. I do believe the efficient market hypothesis is more likely to be true when you're talking about the Apples and the Googles of the world, and much less likely to be true sort of in the sort of 100 million market cap range to 2 billion market cap range. When GME started, when we were discussing initially, it was something like I think like a few $100 million market cap. It would not qualify for a Wall Street Bets post today, and that's one of the problems with Wall Street Bets right now is they're kind of locking out all of the interesting mispricings. But for a while, we had a pretty great forum to circulate and surface a lot of interesting mispricings in the market. So the power of retail to me is discovery, socialization in terms of actual finding of investments. And then there's a lot of agility that the retail trader has that large funds don't have. So for example, as a retail trader, you have the ability to go cash and stay cash for as long as you want. If you're a fund manager, someone is paying you a management fee to manage their money. If you go cash, that's a career move. Either you're going to get fired because you're getting paid by investors to manage your money and all you're doing is holding cash. If it's right, great, you'll be a hero, but you're going to lose investors when you do that, and you're likely going to get fired because you're going to be wrong at some point. So it's very difficult for a fund to go cash in a way that a retail trader can. So I think basically discovery, the ability to invest in much smaller market cap companies where there are more likely to be mispricings, and the ability to not always be invested. I think those are generally the strengths of the retail trader.
Let me add on to that. Oh, go ahead.
So if I could just take an attempt to join up with Dimitri said and what Fat Aspirations said, because I think that you guys are both spot on, that right? Market efficiency is sort of a function of how much attention market participants are paying to any given security. And GameStop is like a great example of there was no attention really paid by professionals, so it was an inefficient market. And there was like a complete monoculture of like adversarial professional opinion on the stock, right? Like the bearishness was just overwhelming to the point that if you wanted to be a contrarian and actually be a professional and buy GameStop, right, that would also be a career move. Only a handful of professionals were able to do it because they managed their own funds, typically their own money. But you know, more public indexes or open funds would be unable to do that as easily. The value play was obvious to retail because everyone could look at it. And I think that, yeah, like in the smaller caps, there's so many more opportunities that retail is able to exploit that professionals systematically can't. And that's a great source of edge for retail in general.
As a corollary, you could go further and state that the more eyes there are on a trade, the less likely there is that there is any edge that you have. And so, you know, extend that to the current state of some of these memes and, you know, decide for yourself whether you think there's anything left there.
Part of the problem with the efficient markets hypothesis is that humans are not always rational beings. A lot of times they're emotional beings. But that aside, I want to add on to what Fat Aspirations was saying. Because now there's so many different views out there, and you can get a lot more information than you could before. One of the more important skill sets is now discerning what is signal versus what is noise, and figuring out where the edge really is. It's really sifting through all this information. Whereas before, maybe it was doing your own modeling, but now you have people who are experts on all kinds of things. Like for me, Rod was, you know, the expert on GME. All these people on StockTwits were the experts. And rather than try to do the research independently, do my own modeling, I feel like the differentiating skill was determining whether all these things were reasonable or not, and where the edge came from. So I think as there becomes more and more information available to retail investors, that becomes a more important skill, rather than doing your own work, figuring out where the edge is by sifting through all this information and picking up the signal.
I'd want to build on that idea about, I think Fat Aspiration said it at first, or whoever it was, like, and I included it in the newsletter, right? There's been a sea change in access to information over both the last couple of decades and especially in the last couple of years. Like there were internet message boards in the .com era, right? And people were talking about their favorite stocks. Clearly, and exacerbated, enhanced, maybe is the better word, by COVID, you saw this hyper increase in the level of time and energy spent online by people, many of whom may not have been active investors. Like Fat Aspirations noted, he was not an active investor. Until I bought GameStop in 2017, was almost entirely passive, for example. But I would agree with what he said, that clearly the efficient markets hypothesis looks weaker and weaker as you observe reality. And with that said, I would ask the group, how much of this is transitory versus how much of this is structural? Because you had people forced in their homes for much of 2020. Some of them might not remain engaged with investing. Perhaps they'll go back to passive investing or indexing. And do you think that this level of engagement by investors, and eventually I want to shift the conversation to the delta between investing and speculating, because clearly there's a good conversation to be had there, but is this something that is going to diminish over time, or do you think that the game has changed forever?
That's a massive Pandora's box of a question. Just quickly, I think my reaction to it is there are certain trends that don't get put back in the box. You know, when information is generally opened and revealed and you get more transparency, those things they tend not to reverse. That being said, there was a flood of investors over the last couple of years, and in a completely raging bull market, it doesn't matter what you buy. You buy and you sell, you'll make money. In a bear market, you kind of need to sell first, and then you need to buy to close to make money, which is something that retail investors are less likely to do. So I think what you're going to see is attrition over the next year or two of a good number of the net new retail investors that started in the last couple of years. We saw inflows in 2021, I think it was, in the market were like 2x what any previous year's inflows were in the general, in sort of like in the general index, in general markets funds and things like that. So some of that is going to reverse, but the information flows are not. And so the sea change of socialization of information is not going to change, I would say.
I see everybody is so rapidly wanting to chime in on the back of your thought, but I think that's a good way to put it. The information that has increased the flow of the flow of information has increased, and I don't think it's going to go back to where it was before COVID. Clearly, whether it's a Discord group, whether it's a Reddit sub, whatever, people are going to continue to exchange information. But you're right that I think many people whose only experience in financial markets is what is it that Dave Portnoy said, stocks only go up? Well, they don't only go up. Perhaps in the long run, the market index will go up over decades, and you can make that bet and rest comfortably at night. But in the short run, prices can very much go down, as I'm sure many have experienced in their own account over the last 6 months or so. So, whether that will turn people off individually, we included some data in the Inside Wook newsletter about retail's trading activity levels as a percent of the overall market, and those had gotten to all-time high levels. For example, preceding 2019, it was 15-ish% of the market was retail trading. And you had two things that changed. You had the elimination of trading commissions in 2019, which obviously made the barrier to trading stocks and options much lower than it was previously, which we could talk a little bit about if we want to. And you also then had COVID. So I kind of agree with you, Fat Aspirations. It's likely going to be a higher base level of information sharing, but many participants are going to find themselves not interested in this anymore when they lose all of their money gambling.
I think it's worth calling out there, though, the secular trend is that retail participates more, right? Like the information flows are only going to get wider. As trading costs have gone down, retail's participated more. Zero commission trading today has a bunch of strings attached, but there's no reason that you can't have paid trading that's very close to being free in the near future. So yeah, I think bear markets tend to wash a lot of people out of the market, including professionals, and some never come back. But the longer term trend there for the next bull market that's going to start whenever, right? I think the long term is up.
Right, they're really at least two separate factors at play. One is the cyclical element with, market peaks and dips that wash out everyone, where, the people around you are no longer talking about stocks and no one wants to invest again. But on the other hand, over a longer period of time, investing has become more and more accessible and will continue to be to do so. And so even as people get washed out, they lose all their money. Even at lunch, I was hearing people talk about growth stocks, how they'll be okay. It's a dip, buy the dip. And inwardly, I was just somewhat feeling bad for them. Eventually they may lose even more money. But there will be people who persist, and it'll continue to be more available to people, and they'll use some of the tools. And like Fat Aspiration said, these tools, once they're out of the box, will never go back in the box.
I think I would say that one thing that's much more true this year than in the past. I think if traders aren't paying more attention to macro conditions and macro trends, they're much more likely to be unsuccessful. There are a lot of headwinds, coming about that are just sort of short-term potentially headwinds, but then there's some longer-term headwinds and there's longer-term perversities in the market. Examples of which are Mike Green's sort of passive thesis, where above 50% flows on passive, and what happens when passive flows reverse away from inflows to outflows? Like, what could cause that? Well, a greater number of people retiring and pulling money out and drawing down versus people putting money in. And two things can drive that. One, it's the sheer number of people retiring, and two, it's the number of people that are working that are contributing to the market. A long enough bear drawdown will actually reduce inflows through passive. And if that vehicle reverses to outflows, I don't know who's going to catch the bid. And when things tend to correct, they tend to correct well past fair value. So if you're a fundamental investor and you're saying, oh, this stock looks great, it's cheap PE, it's cheap relative to its historical values, almost none of that matters if the floor is going to fall out due to macro conditions. And we've got many sort of significant threats. A lot of people assume that the Fed is going to get inflation under control in the next year or two, or maybe sooner. But I don't hear a lot of people talking about the possibility that the Fed continues to raise rates, perform QT, drives the economy into a recession, and inflation is still elevated due to supply chain issues that are outside of a demand issue. That's a possibility. And in that scenario, we're talking about a multi-year stagflation environment, in which case all assets die. And that's a very difficult environment to be in. And it's hard to make any recommendations on any. I haven't posted any DD for months because I just think the macro conditions are so terrible right now that it's really hard to recommend anything to anyone to take any sort of sizable position.
Sorry to interject, but maybe take a look at oil and gas stocks, which are trading at as if price of oil is still $65. So especially in stagflationary environment, they should do well. I wanted to go back a little bit to the efficient market hypothesis and just state for the record, I believe it's total bullshit. And we've seen many examples of it, but also in terms of, and I'm jumping all over the place. When we talk about retail versus institutional investors, I think as we observed recently, at least, a lot of those institutional investors who pretended to do bottom-up fundamental research, etc., turned out to be just momentum-driven, highly leveraged shops like Melvin Capital obviously comes to mind, but also Tiger, ARK, etc. It was just momentum, right? And now the tide is going out and we can see who is naked.
So let me switch kind of directions just a little bit. And obviously, there's a big difference between buying the market, buying an index. There's also a big difference between trading a company. So I would guess my next question would be, what are some of the ways that you conduct for let's say that you're trying to find a company to invest in for the long term? You're trying to do like Warren Buffett does. Warren Buffett's buying Occidental Petroleum, to Dimitri's point, and Warren Buffett is not somebody who just buys and then flips and sells. A couple days later, he's looking to buy and never sell, or wait many years to sell. So I would open it up then. What are the primary resources that you all are using or that you find valuable in conducting that sort of bottom-up analysis?
Well, okay, I'll go first since there was a period of silence. I actually, strangely enough, found that Twitter, my Twitter feed, frequently has really interesting ideas, and frequently they don't pan out. But taking that and then looking into it from perspective of macro and also obviously reading 10Qs and 10Ks of companies and kind of figuring out if it's the juice is worth the squeeze works well for me.
I think everybody needs a process, and I think it's more important now than ever. I mean, and the process kind of breaks down into the following things. What's your what's your process for discovering or coming across idea? It might be a screener, it might be Twitter, it might be Wall Street Bets, it might be something. You have a process to basically screen for new ideas, and then you need a process to evaluate that idea. And this is where sort of, as Dimitri mentioned, going deeper into your own research. And I think this is extremely important now, particularly because if you haven't done your own research on an idea you've discovered, it's unlikely that you have any real conviction in your position and an understanding of how to handle the volatility. And when you have low conviction, you're going to lose to volatility, because what's going to happen is you're going to question your investment as soon as you see a drawdown, and you're likely to sell as soon as you see a drawdown. So I think it's really important to have a process for your own valuation, as well as a process for your own sort of loss tolerance levels. There's a saying that when volatility goes up, you take your position sizings down. I think it's absolutely true for now, because it's much harder to have a conviction level that will insulate you from losing to market volatility. So the last part of that process is constant, and I mean like constant reading about macro risks and changes, and understanding how this is the year, I think, to really level up your understanding in terms of how do bond markets influence equity markets, and what's happening with global bond markets in Japan and Germany and Italy, and how does that affect equity flows? And these questions that may have not been important in the past because things were just working fine are absolutely important now. And as well as things like hedges. How do you take a position and then trade against yourself? So all of these things are extremely important this year. And so when it comes to like tools, like the tools for each of those parts of the process are different. So for screeners, there's everything from Discord groups to Twitter to FinViz screeners to brokerage screeners. And then that's the input. And then you have the 10Q process to evaluate, to do the financial reports, to do your own DD. And then there's macro, which, you could do things like listen to Real Vision or listen to Macro Voices, and then read a bunch of, and then go deep on the sources of the guests that they have on there. Jim Bianco is a good person to follow from the macro perspective. And I would say like have tools in each of those buckets for whatever tools that work for you. Like I like a site called roic.ai for just a really cursory quick glance over fundamentals.
That is a great one. roic.ai. It's fantastic. Quick one.
Yeah, it's a very, very good like quick summary of financials, and it saves a ton of time with initially looking at just the key numbers on business. So that's my 2 cents. I think it's not just a tool. I think you need an entire process, and it's emblematic of the fact that things are just going to be much, much harder this year, and need a lot more work before you take a position.
I agree that you need a process, and since a lot of people have mentioned it, even though Rod mentioned, how do you go bottom up, but increasingly my approach is top down because of all the macro forces at play. And one of the problems is that when people think about macro, they do on too short of a time frame. This is a problem that we even saw with GME. People were looking at GME at a 5-year time frame, even though the console cycle was longer than 5 years. It was ridiculous. It's like giving someone a 6-month temperature trend. It doesn't make sense. And so some people, when they look at macro, they're only looking at it from 20, 30, 40-year time frame, when there's only been decreasing interest rates. Whereas I think it's better to go longer, even to read someone's work like Ray Dalio, in his most recent books, How to Deal with the Changing World Order, or some of his earlier books, to look at from a century, time frame of centuries. How do these cycles work? So that you have an idea of where the cycle is and where the cycle is going. And then from the macro standpoint, then you decide what industries to get into, because now increasingly there's a very high correlation between stocks within the same industry. And you could decide even before you go to individual tickers to invest in something like XLE or XOP, if we're talking about oil and gas, before you dig down even further into individual companies and their 10Qs. So I agree. We need to have a process, and increasingly, my process is top down. First, what's the macro, and then which industries will benefit, and then which individual stocks within that industry.
To build on what you just said, Science, I think a good rule of thumb is if you don't have any sort of an edge, like for example in the energy space, if you don't know anything about exploration and production, midstream, downstream, whatever, like just buy XLE. If you want to have exposure to energy, you shouldn't be making it that you think you can outsmart everyone else. If you don't have any sort of informational edge, then that's where indexing to the sector could make a lot of sense, and not looking to identify an individual security, because what is the reason that you would be wiser than the market in that circumstance? Now, I'm not saying that holds true for everyone, but I would argue for many, especially newer market participants, they've probably overvalued their edge or their depth of insight and knowledge, thinking that they're smarter than they really are. And they might need that dose of humility to realize they don't in fact have an edge. And if it's nothing wrong with saying that or acknowledging that.
I think
Yeah.
to build on humility. Oh, sorry, someone else was.
So, sorry, just briefly. I think I overall agree with this sentiment, but I would say so for me personally, I keep rotating through different industries. There was, have.
Dimitri dropped. We'll get him back, I'm sure, in a minute. But hey, Captain Hubbard, you joined late, I know, and we ran through intros. But you were someone who I think a lot of folks who were in the GameStop story probably appreciated your fantastic writings. And I just wanted to give you an opportunity to introduce yourself, and thank you for joining.
Yeah, hey Rod, hey everybody. I appreciate the invitation here. I probably am at the bottom of the list in terms of the ability to provide any insight here, and I love hearing my man Fat talk there and everybody else. It's great to hear everybody's voice. Sorry for joining late. Had to do a thing at a kid's school, but it's been fun listening to the last 10, 15 minutes, although Fat, you kind of terrify me as you always do, but happy to be here.
Awesome. Look, it's almost 5, so I'm going to just move the conversation forward just a little bit, and then I want to open it up to some questions for folks in the audience. I know, it's been good to hear, Fat. I hope you didn't terrify everybody, but the reality is people need to think about risk just as much as they think about the reward. And I had the opportunity recently to read Seth Klarman's Margin of Safety, and there's a huge spectrum on your pure investors, the Ben Graham adherents, the Warren Buffetts, the Seth Klarmans of the world, who are trying to buy a dollar bill for 30 cents on the dollar, 50 cents on the dollar, whatever, with a meaningful margin of safety, versus on the other end of the spectrum, the young man or woman buying the 0 day to expiry call or put option that they bought at 9:45 this morning and then sold at 10 o'clock this morning and tried to flip their FD real quick. So I guess the next question I would ask is I'd like to have a little bit of a discussion about the difference between investing and speculation / gambling. I'd like to ask, the meme frenzy that happened last year, what does it mean? Does it mean anything? Is it unimportant to the future? Was it just a blip in time? And also just like how the world of today, this hyperactive world of today, kind of makes it hard, where you blur the lines between investing and speculating. And I know Jeff Amazon's been quiet, and I know he has thoughts on the matter that technically everyone, I think, I don't want to put words in his mouth, but Jeff, I would invite you to chime in. I know you're busy, but if you're able to chime in on your thinking on investing versus speculation, and let it go from there.
Sure. I think I don't want to say the word speculation. I'd prefer the word trading. Seems more sophisticated. But yeah, I think a lot of people mistake trading for investing and vice versa. To me, you're trading if you buy an asset at a certain price, wishing to sell it later down the line for a different price. For example, if you bought Apple in 1990 and you sold it in 2020, you're probably just a trader because you haven't actually contributed to the company. I think you're an investor if you invest, if you put in time and resources into the company, expecting, a result from your efforts. You could possibly be labeled as an investor if you, buy a company and you sort of provide stock-based compensation, but I think, it'd be healthier if people categorize it correctly. You're not an investor if you're just, looking at charts, and even if you're doing fundamental analysis, like from the bottoms up perspective, I wouldn't call you an investor. Like Melvin Capital, for example, are they investors, or are they just picking names and managing assets? It's a very difficult line that I think there are far less investors in this world than people actually think there are.
Maybe the question is what definition we're going to use for investor versus speculator, because let's say Ben Graham used a strict definition of investor where you are pretty much guaranteed the return of your invested capital and a reasonable return, whereas versus the speculator where it's not.
I think those are all, it's a good discussion. I think the question, as I see it in my mind, is how should someone who's managing their money today balance sort of an investment mindset versus a speculator mindset in their operations? For me personally, I think this is all about sizing. I have a small shitfolio, basically, in Robinhood that I keep to a certain size, and I use for, basically fun trades that are with money that is basically meaningless. And that portfolio is up like 70% year to date. It's much easier to make a small portfolio move in a significant way through speculation. My large portfolio is down. It's down less than the market, but it's down. It's not, it's down a tiny amount. But it's because it's a very different philosophy that I'm using to sort of think about how to manage the money that is much more significant to my future than that I'm using for speculation. And I think this is true for a lot of people that were in GME, where you walked into GME with a certain amount of money, and if you participated early enough, you walked out of GME with a much larger sum of money. Now, in that time period, your account may have 10x'd. Your skill as an investor, as a trader, did not 10x. And so you need to have a certain amount of humility in your abilities and sort of segment your assets in a way that to hedge against your own decision-making ability. At some point, it makes sense to take a big chunk of your portfolio and keep it just matched to the market, and you should be using a smaller portion of it to speculate against that position, either to beat it or to hedge it. That may not be now, but I think it all depends on sizing and how meaningful that amount of money is to the individual. You and other people have said this, you cannot trade a large portfolio in the same way you trade a small one. So I think ultimately speculation is sort of playing a game that you're buying something, but somebody's going to pay more for it in a very defined period of time. Versus an investor, you're generally contributing capital to an asset with some expectation of future cash flow returns, whether they're dividends or buybacks, which would result in greater equity ownership per dollar invested. Those are both cash flows. And so those are kind of things you think about. And this is why the large investing world, when faced with a change in bond returns from 0.1% on the 10-year to 3% on 10-year, are thinking very differently about cash flows. So I think it's the answer to me is there's a place for both types of thinking, particularly if you've been active before. The danger is to control your active decision making on your portfolio so that it doesn't scale too far, too fast. Don't mislay your portfolio gains with gains in your skill.
I think that right there is essential for anyone listening who has had incredible returns over the last few years, whether it was one great trade or whatever, realization of some investment thesis. Humility is a really powerful thing. Even the world's best investors find themselves wrong a lot. And just because you had a great result, you really shouldn't conflate it like that aspiration is noted. You really shouldn't think that that's inherently a byproduct of your skill. And I think we would all agree that GameStop, there was a massive amount of luck and fortune involved, no matter how much we thought that at $5 per share or $10 per share or whatever, there was meaningful upside. Sure, of course, that's great and all, but for it to go to nearly 500, there was none of our skill was involved in that. That was the function of what became a full-blown financial mania. But anyone else have any thoughts on that kind of this paradigm between investment and speculation / trading, as Jeff and
I kind of want to touch on something we're mentioning earlier with regards to the rise of retail and the efficient market hypothesis. Just because you guys were mentioning not conflating luck with skill, I think that yes, markets are pricing in things faster, just because the flow of information is so much quicker with the internet and social media. The question is that little piece of information that you're reading on your Twitter screen, is that giving you an edge? If you trade on it and you make money, does that mean you are right? So it calls for a lot of judgment. I think the most dangerous thing could be a false positive, thinking that you're right when you're actually just extremely lucky.
Yeah, very good. Look,
There's
okay.
The last thing on luck and skill. I think there was some skill involved and luck involved with Jimmy. The way I think of skill and luck in general with opportunities in your life is the world will always throw opportunities at you. Opportunities exist every single day at every single moment in the market. Your skill is the ability to identify those opportunities. And I think with Jimmy, it was just, frankly, it was an easy mode. It was extremely, as soon as someone pointed it out, it was extremely easy to see the opportunity. When things go in hard mode, it's harder to see the opportunity, but skill is the ability to kind of determine that something is an opportunity when luck throws it your way.
Sure. And you have to seize that opportunity. And I think we obviously all experienced GameStop a little bit differently. Those of us who are in here as speakers, I think by and large, were long from whether it was low or mid single digits or teen levels. And most all of us sold all or most of our shares at meaningful gains, but we exited and no longer saw it as a meaningfully good opportunity once the share price exceeded, say, 300, 400, whatever dollars. One thing, I guess, just thinking about GME, just, I talked earlier about like examples of unique, interesting insights. We talked about like scuttlebutt research, hearing Sir Jack, who had to talk about the VTARD group with regard to steel and his experience there. And we talked about, Dimitri talked about the Microsoft deal with GameStop and kind of taking that extra step beyond, to dig in and understand things better. I think one interesting story, and John, I would invite you to just kind of share it, just thinking in that vein of like that deep dive into things. Like, I know you reached out, for example, to Ryan Cohen in late 2020. I think it was December 2020, because Cohen wrote this letter to the board in November, and I forget who it was on the call made the comment that when you read the letter, clearly this person had intentions to invite others to kind of get a better understanding of what he was doing. I know Justin did speak to him as well, but John, you spoke to Cohen. Could you share that experience a little bit?
Yeah, I mean, I think this was before. Well, he's pretty much unreachable now, but back then, yeah, I just wanted to get a little bit more thinking on what he was planning to do after he wrote that letter. So, yeah, I found him on LinkedIn actually, and I just messaged him, "Hey, we're shareholders, and we want to learn a little bit about your vision and plan." And he was gracious enough to, invite me on a call and discuss some of his planning and outline. Of course, we have to be very careful in terms of from a legal aspect, right? Because you can't get votes or for a proxy at that point. But yeah, the bulk of the discussion was based on strategy. But the most important thing for me that I took away was, hey, this guy is definitely in it for the long haul. And if Sherman wasn't able to turn the company around alone, like it gave me a lot of confidence that he wouldn't just sell out his stake and his shares. And of course, we did a lot of homework on his history and the things that he's done with Chewy and his interviews. And based on exactly where GameStop was at the time, we all held a strong belief that, yeah, he was the guy to be able to turn this around, especially ahead of the console cycle. So all of the stars aligned at that point to me. And then I do remember we discussing this and, increasing our stake. But yeah, just a LinkedIn message. Funny story now that I think about it.
Well, that's a good one, John. Increasing your stake, and I remember we had a conversation about this, and this is obviously before Wook came to be more than just a vague idea you had floated. But one of the things that, especially in this market, we've heard some discussion, and Cyanide shared, and I know he had to drop, it looks like, but he shared the point that people are like, oh, buy the dip, buy the dip. What's harder than buying the dip is averaging up, and averaging up, it feels uncomfortable to see, oh, my cost basis is this low, whatever, and now I'm going to pay this much more for it. So, like, John, I guess I would ask you, and then I would kind of open up to the group, like, how do you control that, like, psychological aspect of it? Like, the company, if it's better, it's a lot better, you should be willing to pay more for it, right? Like, after Cohen settled with the board and was going to become chairman, like, well, it should have been worth a lot more. The market didn't really react much at first. It eventually did within a couple of weeks. Yeah, like, what's the psychology of when to buy the dip versus when to average up and so forth? I would open it up to that, and then after we have that chat, I'll shift it open to Q&A.
Well, I think it's just it's a psychological battle for sure, right? And it's just a matter of assessing incremental facts and information, and think about how the odds have changed in your favor, and how much does the price reflect that today? And that changed significantly, especially for GameStop. But you're right, it is hard, because I remember the lowest purchase price was, for me, was like $2.83 or something in March 2020, and then the highest was just under 20 right after, like, in January, when he was um, when he was head of the board. But and then that was hard, because it's literally almost 10 times more. But that to me seemed like a better deal than $3 back then, actually. So it's hard, but you just have to objectively assess incremental information and decide for yourself whether the price does accurately reflect that. And at that point, it was our belief that it didn't. So I think it's important to just not try to predict things as well in terms of what's going to happen, and just have a set of outcomes in your mind, and have some
You mean you
probability.
didn't predict that within 2 weeks of buying at 20, it was going to be at 400? Just kidding.
Of course, we did not think that, but I will say it was a tail outcome that we had in mind, precisely because of the short interest, right? It was the highest in history, and then we knew who was short and by how much, and then all these weird things going on with the stock. So, did we rely on that outcome? No, but we didn't need it for it to be a successful investment. But and that's really why it was the greatest. I think it's probably the greatest trade we'll probably see within our lifetime.
One thing for me that I struggle with in terms of averaging up is the emotional aspect, because when it goes up, I tend to get more greedy, and I think a lot of people can relate to this. But what I found out is there's always a pullback. With GME, there were multiple 30% pullbacks. I think Sir Jack, got out on one of them because he said it was spiritual for him to see that huge hit to his portfolio. But the more we go on, the more we realize that there's always a pullback, and because of the human element, as it goes up with the momentum investors, they try to jump in. But if you can control or deal with the emotional aspect, often you can buy it at a better price, even if you have to average up.
Yeah, I mean it's rough when you're trying to balance whether it's going up because you were right or whether you're chasing. And the chasing part that kind of hit everyone over the last year, but you kind of have to get that original price target. What I kind of leaned on was Rod's model. Once GameStop came back down to like 40, we all thought it was still going to go down a little further before it finished, and then expected it to kind of sit until Cohen went back up. But we had that price target, between 60 and 160 ish. So starting to average back in even at 50 and 60 ended up paying off pretty well. The psychological aspect is just it's brutal, because anytime a stock moves, you either want to get out or you want to buy more, and both directions elicit the same response emotionally.
I would say for GameStop, this I think this it's slightly different than for some other.
Dimitri, I'm not sure what the deal is with your device. It keeps sending you back. I invited you back up. No, I think okay, there he is.
No, that's me. I think while we're waiting for Dimitri, I think I'd say the harder. Go ahead, Dimitri.
Connection issues. I was just gonna quickly say that for GameStop it was one thing, but there are some investments where when the thesis changes, when you see significant improvement in underlying macro or something else, the higher price is much easier to pay. Averaging up is much easier. Let's take Zim, container shipping company, right? They generate so much cash that I have no problem paying, let's say $4 per quarter higher every quarter than before, just because they throw out so much cash.
I think for me, I would say, and maybe some others in this call, what might be relevant now in terms of what's a hard thing to do is not necessarily averaging up, and it's not averaging down. It's choosing not to play. Some people might be staring at sort of losses in their portfolio, and they're choosing to stay invested or to increase their positions or take other bets with sort of a mental, psychological desire to reclaim some past number in their portfolio. They're trading to their portfolio rather than trading to the market. And the hardest thing to do right now might just be to take your ball and go home and wait it out until market conditions sort of settle. That's probably harder to do than anything, right? And that might be the wisest thing to do. I mean, there's this just a 2-second thing on cash. Like, cash gets a bad rap in inflationary environments because people think you're losing money to inflation. Actually, I think that's not necessarily true, in the sense that you should think of 2 buckets of cash. The amount of cash that you need to operate, let's say, a year's worth of expenses, or 2 years. That bucket of cash is going to lose to inflation. But generally, the excess cash that you have is going to be exchanged for financial assets. And in an inflationary environment, financial assets generally go down. So you should be thinking about 2 ratios: cash over a gallon of milk, which is your operating cash, and how is that ratio looking, and cash over the market. Cash divided by, like, say, an average share in SPY or whatever, something like that. And generally, cash over SPY is doing pretty well. And so it's not unwise to take your ball and go home in an inflation environment and just wait for the inflation battle to be called in a much clearer fashion. I think that's the harder decision to make. And you may have an edge, like Dimitri mentioned, with oil and gas. You may want to buy XLE. To me, it's a little scary. It's a 5-year high, and I don't even know that much about it. Again, you have to build conviction in these things. But if you're not ready to do that, like, cash is a position, and probably a pretty good one, considering its low volatility and high liquidity, which is exactly what you want in a market like that.
Yeah, I think you're right. There's this natural distaste, whatever, for holding cash, and you're right. And people that have been overweight cash, I think, are reaping the benefits, and very well may reap the benefits in the coming months and years, as it is a very, very dangerous environment out there in the world today. It was already a big question mark before you had China go back into lockdown and Russia opt to invade Ukraine, and you add those two wrenches into the machine, and clearly there's a lot of smoke coming out of the machine, and no one is quite sure what the machine is going to look like. And by the machine, I mean the both domestic and global economy. So you're right. There's a lot to think about. I want to invite some folks up who are requesting to speak, and welcome anyone who'd like to ask any questions of the audience. Please be respectful. If you start to do dumb shit, I will have to mute and or remove you, but I certainly would love to hear some different questions for the audience. Obviously, no one is obligated to answer. It could be for me, for John, for any of our guests. Jimmy, you're up. Mr. Badass Trader, I've also added you as speaker. If you could just wait for Jimmy to go, though. Jimmy, please chime in.
Hey, Rod. Thanks for having me. And all of you guys, it's been really fascinating to hear your stories from the ground up. Full disclosure, I did not participate. I had looked over GameStop in 2018, 2019, when it was in the kind of in the tens, and then kind of in the low single digits, and the death of bricks and mortar, all that stuff. But anyway, I guess whether I'm speculating, trading, or investing, my question to you is, for you guys who have outsized positions, perhaps there's some house money in there. What are you doing to protect your downside? What's your risk management going into this environment? I don't think it's a surprise to say that we're not in 2021 anymore. The factor exposures, especially from the algorithmic side, have turned against a lot of the high flying growth stocks, the meme stocks. I'm not a technical analyst. Rod knows, I'm a fundamental guy. The technical guy says, hey, the chart looks awful. It's about to break and fall back to 20. There's a lot of similar sets with collapses and speculative things. And then we're going to get more, we're going to get tighter liquidity throughout the year, or certainly over the next few quarters. And then the fundamental guy says, I looked at their balance sheet. They've got about maybe like $2 billion in cash. If you take your assets, their inventory at book value is about $2 billion. They've got some liabilities, but net, let's say they have about 500 to a billion, 500 million to $1 billion of cash, and the company today is at $7.5 billion market cap. So there's a lot of expectations. I think as a fundamental investor, we're maybe in the middle of crypto winter now. So all these things add up, right? It's easy to get bearish. I got to imagine with all the theta burn, if you didn't get in at the ground level, a lot of people have 100, 200 or more base cost basis. So they're underwater. They're getting blown out. That's it. I'll stop the FUD. But as a bystander in all this and looking at the similar sets, I just wonder if you're still invested in this name, what keeps you in, and what are some of the things you're utilizing? Maybe a vertical put spread or something, right, to get some protection for your gains.
I don't think there's a reason to be invested in GME or AMC or any of these names anymore, right now at least. Like I said before, I think the more people look at the trade, the less likely there's an edge. I don't think there's an edge right now. There hasn't been a short squeeze thesis for ever since, basically the first or second squeeze. But maybe the reason to be in GME is that it's a small portion of portfolio, and you're waiting for one of those completely unexpected and unexplainable pops that it has every now and then, and that's what you're hooked for. But other than that, I don't see a reason to be in these names.
And that's not an investment thesis, obviously. That's pure on speculation, or perhaps a trade thesis, as Mr. Amazon would like to put it. But I'm not going to go in deep detail. We've obviously published extensive research at GMEDD on what's been happening with the company, but to the point on, there's a lot of value priced in, expecting future cash flows that remain to be seen. So it's inherently a highly speculative investment in a space that is uncertain, right? And an NFT marketplace, a blockchain wallet, whatever the extent of the blockchain-oriented products end up being from GameStop, could that be a huge cash driver into the future if that market continues to grow? It very well could be, but as I think everyone would agree, there's a massive range of uncertainty, and you're paying a pretty hefty premium against what the assets on the balance sheet are worth today. So, there's a lot of people that own it and don't care about any of that and are emotionally owning it. And I don't think anybody on this panel is in that category, but I will say I own 100 shares, which for me is less than 1% of my portfolio. But I also, I'm comfortable with that. That's a comfortable allocation for me. I don't think people, that have 100% allocation to memes are going to feel very good in a couple of years, to be honest.
Yeah, a quick follow-up to that. Just again, let's say you've got a lot of house money, you're in a taxable account, you don't want to pay your taxes. What are you doing to mitigate that risk? Are you employing hedges? Are you short other factor exposures? Are you short AMC? Right? Like, what are you doing there?
Yeah, I think having some kind of hedge for pretty much any investment right now is a pretty good idea. And keeping some cash.
Yeah, that's one that I think there's, if you're talking about you have a position in a taxable account and it's open and you don't want to realize the gains, maybe the short term, you take a hedge against it. I mean, if you're talking about GME, I posted that AMC is actually a pretty good hedge against GME, like it's a short AMC against GME, and you'll probably do fine. If you're talking about the wider market, I have some long-term holdings in general market, and you can go long SQQQ, or you can go short, SPY in a taxable account to basically remove some delta from your exposure temporarily, and you can control how long you want to hedge in that way. And the indices have pretty low borrow fees, so given that VIX is pretty high right now, if you're talking about hedging against your portfolio, buying spreads, buying put spreads, or just going outright short against an otherwise delta long position, probably makes more sense than just buying, straight naked puts. Straight long puts.
Yeah, totally. That's helpful. Thanks, guys. Yeah, definitely to get some of the beta exposure mitigated, definitely like an SQQQ. And if I don't want to pay for that theta burn, maybe writing, what is it? The inverse of it is like I'm writing puts or something, so I'm not dealing with that. Instead of being long SQQ, I can maybe basically write puts against SQQ or something like that. I don't know, but yeah.
You could sell covered calls, right, against your GameStop position with a strike price, which will not get exercised at least for a while. But then the question becomes, well, eventually, what is your idea of GameStop? Do you think it will continue going up or not? And if not, eventually you will have to pay.
I think it can be a $15 stock by the end of the year.
Yeah, so if you have to pay those taxes eventually, and at the same time you have opportunity costs, because even if you use equity in GameStop to buy something else, I mean it's still less than if you had outright cash potentially, and you would be safer just taking profits and maybe redeploying it.
Okay. Yeah. Thank you for listening to my question. Just love to hear your thoughts, right? Because you guys are in this name. You have skin in the game, and I don't. But I'm looking for a chance, maybe next year.
I think the reality to that point is just because you like a company or a business should have almost no bearing. I mean, should have no bearing on whether it's a good or bad investment at the particular price that the market presents to you. And I think that's where a lot of newer people in the market, I think, have run into trouble, where it's quite all right if you want to encourage, whether it's AMC, Bed Bath Beyond, GameStop, whomever your meme du jour is, that you want that company to succeed, but that doesn't entail or require you to allocate your hard-earned investment dollars at astronomical valuations relative to history. And you can disagree, and obviously I try to be respectful with my disagreement on people. Like yesterday, I posted a chart of AMC, noting that AMC is still, despite drawing down 80 whatever percent from the all-time high, is still trading meaningfully higher than it ever did before COVID. And the business is not meaningfully better than it was
with the sheer
before
dilution
COVID.
to boot. They've massively diluted that balance sheet. That's worth $2-3 tops.
Exactly. Take a look at the chart I shared yesterday. It's rough, and it speaks to the fact that a lot of people just look at price charts, and that is not a good way to go about things. But I added Badass Trader 69 up here.
I'll hop off so
I
you
had
can
been
come
trying
on.
to
I know there's a
add.
limit to speakers. Yeah, it's like 10.
Oh, okay,
But I'll
that's
go back
why,
to the
'cause
listener
I
queue.
kept trying to add them, and it kept giving me errors. So sorry, guys. Jimmy, I'm booting you now.
Yeah, thanks, appreciate it.
All right, Mr. Badass Trader, please, you are welcome to ask your questions.
Hey guys. So first off, I'm a DD writer and Supersonic mod, and I get that you guys are all like the OG apes from GameStop, but do none of you still maintain the belief in terms of MOAS? Like you're saying that there's no existing short squeeze thesis, but looking at the SEC report, like we know that shorts haven't closed, and there's still probable multiples of the float existing in terms of naked shorts, and like for the active community that's out there now, like we believe it hasn't even begun, and we haven't seen a fraction of it yet. Do none of you guys believe in that?
I'll let Alpha. I saw you want to mute yourself. I know Alpha and I have very disparate. I'll let him chime in first, and then if anybody else on the panel wants to chime in, and yeah, please go ahead, Alpha.
So I still own some GameStop as a analogical option on upside volatility in it. And if you look at the trading data, I agree that it's anomalous, and it's not really consistent with the rest of the market, and it hasn't been for years. That being said, there is a difference between making the observation that the trading behavior and the fails and all these sort of weird back office market structure things look off, with then concluding that there's going to be a MOAS, right? And we saw January 2021 that market structure can break, and people have no qualms with changing the market structure, changing trading rules to preserve like the vast financial infrastructure that's out there. So, it's worth evaluating, could it create additional buying pressure in the stock that sustains the price above, whatever valuation seems appropriate? It could, right? We've seen that in Tesla, but I don't think a MOAS thesis is necessarily a sound conclusion just from making those observations.
So just on that, so it's not necessarily the price action or anything like that we're talking about. It's the actual short positions that exist. And if there was a short share recall or fucking sorry for cursing, a dividend, an NFT dividend or anything like that would actually prove the existence of them and trigger a short recall.
Can I ask you a question? Are
Yeah,
you
sure.
asking because you actually want to know our answer, or are you asking because you're trying to convince us?
No, I am actually asking because I want to know your answer, because you guys are the OG apes, and I'd love to know the psychology of where you guys were versus where we are.
I don't think anyone on the
I am not an ape.
considers himself that.
Yeah,
I know that I've personally made it clear. I find the word distasteful at best, because to me the word ape, when I think about that, I think it just means like a mindless pursuit of something. I don't think there's thoughtfulness And I'm not saying that that means everybody who self-identifies as one isn't thoughtfully analyzing and assessing things, but I would posit that most of the folks who consider themselves, as the aforementioned hedgehogs, wouldn't consider themselves apes. And while yes, there's been quite a lot of weird activity in the price of the ticker, there's been a lot of weird activity in AMC, and it doesn't necessarily mean that it makes it a good investment from a long-term perspective. To the point of, could it shoot up 100% tomorrow? Obviously, it's a weekend, but next week, and would any of us be all that surprised? I don't think so. But when I see people writing things like, "Oh, it's going to go to 10,000, 100,000 per share, a million per share," and it's completely disconnected from anything that resembles reality, I think that's where a lot of the credibility disappears. So while I have no issue with people trading the stocks as tokens, look, there's obviously been a lot of reporting about swap positions, whether it's on the long side with Bill Hwang's Archegos accumulating massive hidden long positions. Melvin Capital had a very large short position, but no one is incentivized, unless you believe there's some massive market conspiracy, to hide giant swathes of a short position in a ticker. Like, I think most of us on this panel, other than Alpha, would agree that most short sellers who were short GameStop preceding the end of January 21 were either forced closed out or closed out themselves. And that doesn't preclude new short sellers from entering, right? There's not some one singularity of short sellers. Anyone is welcome to short a stock if they can locate a borrow at a price they think is supremely overvalued. And that's just the market.
So I would, if you want to know my position on this, you can go back and read my first endgame DTC Infinity, DD on GME. That was basically my.
I have read it.
Yeah, and I don't think any of that is valid anymore. Like all that has been unwound. I think if it was not, if the trading of GME wasn't uncapped or was not restricted, I do think we would have gone to ridiculous heights. But as soon as that was done, I think that provided an opportunity for shorts to really get out where they needed to. But you have to think about this from the perspective of what I said earlier. GME for a long time was not a crowded trade. It is, GME and AMC are the most crowded trades in terms of just people expecting this thing to go rocket. And if nothing else, for that reason, it's not going to work. And I've read the more recent research. It tends to fall short of really what the setup was the first time. Like, for example, when Cohen was added to the board, you didn't see the stock rocket for 2 days. And the reason for that, I generally believe, it's hard to say for these things to be true, but it took exactly 2 days for the stock to quickly double basically after he was added. Cohen had something like a 9 million share position in GME, and as an external investor held in a broker-dealer position, those shares were probably lent out to institutions. And as soon as he became an insider, it is no longer within the bylaws that he can have those shares lent out. And so they were recalled. So exactly 2 days later after the recall, you saw shares spike. And to the tune of the volume, it was very, very much tied to basically Cohen's ownership. So it was a clear reasons to see the jumps. And right now, there isn't a lot of clear reason for any of that. I do trade GME now, but it's not for MOAS. I sell puts at 40, at the 40 strike, because I can get a 2% yield in a month on my excess cash. And it's my favorite way to make money on GME right now, but that's the only way I trade GME. And sometimes I sell calls when it spikes, and I'm sorry to say that for people, but there is an upper bound here, and it's not going to go up in a straight line. There's no underlying reason in the same way that was before, where you literally had more shares short than could be covered. That's not the case. And as much as people DRS or hold, all that does, all the current actions of current investors, all it's doing is reducing liquidity in shares. It doesn't mean the price goes up. Liquidity just increases volatility. And so when volatility goes up, there's profitable ways to trade that, but it's not by staying long with any sort of without a lack of hedges. If you do that with an increasing volatility asset, you're almost guaranteed to lose, particularly if you have things like margin exposure or you'll sell on volatility, like I've mentioned before. So yeah, I don't have a MOS belief. I don't have a MOS position. That's kind of my position on GME and AMC and many of the other stocks right now.
Yeah, same here. And if you recall, at the time when the squeezes, probably gamma squeezes and then short squeeze started happening, before that, the official short interest was 140% or so. Obviously, the official number is significantly lower now. And then the question also to me, frankly, would be, there is a low probability of potential squeeze, right? But then at the same time, while you're waiting, there is an opportunity cost to that. So I frankly don't understand why people don't just go and do something else.
Well, the reason is that you can't use logic to get somebody out of a position where they didn't use logic to get into it in the first place.
All right, good discussion. At the office too, I had added you. I added another Shale 94, but at the office too, if you could chime in with your question, please go ahead.
Hey guys, thanks a lot for your time. Really liked all you guys' insight. I guess two parts maybe. What do you guys think of the recent? Just chiming off that last point. First, what do you guys think of Cohen's buy-in around the 90 to 105 mark? But my main question was, what else are you seeing as hedges kind of going into the next year? Bearish. I know you talked a little bit about oil. Cash, of course, it's not trash anymore. Wondering if you guys had any other insights.
So let me respond for the Cohen buy. I think it's important to remember that retaining employees is obviously an important consideration for GameStop. They brought in, as Joe has diligently and the team at GMEDD has diligently reported on, hundreds of external hires from blue chip technology companies. Now, when those people were brought in, the share price was meaningfully higher. So you don't want those people to find that equity and options they were granted has fallen, 70, 80, whatever percent, and lose those hires. So I do think that, and see you later, Jeff. Saw Jeff Amazon just drop. That partially it's an attempt to ensure the price remains, higher than it perhaps otherwise would in the absence of insider buying. I think the other way to read it is that Cohen, Atal, and Larry Chang, who all made open market buys, genuinely believe that the digital upside from blockchain represents, from 90 to 100 whatever dollars per share, that there is in fact upside from a business fundamentals perspective. So I think it's a combination of messaging that view and ensuring that the price remains elevated to retain employees. Those are the two reasons that I can see. And I'll pause and let others chime in. And not seeing anyone else chime in, I hope that's an adequate response. I forget if there was another part of the question I missed.
Yeah, thanks for clarifying that. But I guess kind of going into the
hedges.
Yeah, most of your hedge looking forward for like the next year to whatever we see before we turn back the other way.
Yeah, I think that Fat noted the long GME hedge with AMC. I also have noted that, I think, since last summer, and I know it's done well. I think it may continue to do well, but the fact of the matter is cash is king. It doesn't hurt to hold more cash and wait for opportunities to be more clear. Some of the index hedges don't cost that much. Obviously, volatility is something you would prefer not to overpay for. Spreads can cheapen the cost of hedging. I think about other meme-like assets that remain very richly valued. Tesla comes to mind. Those could be opportunities to look for other richly valued retail-friendly assets. If you think that retail largely has not been a seller, the data I keep seeing, like Vanda was reporting that in March, retail inflows was the highest ever on record. Obviously, the quote-unquote smart money, the institutional money, has been selling. Retail does continue buying. What happens when and if retail starts selling? So I would think things that retail is largely long, you may want to have, whether it's a direct hedge to, if you're long GameStop, maybe you want to own some GameStop shit puts as a hedge. Obviously, you need to consider theta and volatility. And the reality is a lot of people are trading complex securities and positions that they may not understand all of the puts and takes of. But yeah, those are some of my thoughts. Happy to hear others on the panel chime in. Alpha Hound, I'm putting you on the spot. What's your hedge?
I mean, I have more cash than I usually do. I think Fat's absolutely right about that. The opportunity cost of having a hedge that doesn't work is substantial. And while you can look at different things, like unless you are sure that you are actually hedging yourself, not just something that in theory hedges, probably better just to hold cash.
Good stuff. Okay.
Thanks, guys. Really appreciate it.
Thank you. All right, Mr. Shale, Shale 94.
Yeah, hi. Shalle, yeah.
Shale.
Hi. Yeah, great discussion. Just a quick question. So I've been watching the Roaring Kitty streams quite often, and something that has always been in the back of my mind was no one on the stream ever curious about who this guy from Wall Street Bets, who was regularly posting his GME YOLO for a year, was? Like, did no one on the stream ever ask who Deep Fucking Value was? Like, considering how much you were talking about GME on the stream. And second question, will this recorded talk be posted somewhere?
So to answer the first question, I can probably answer it as well as most, given I was on almost all of those streams. I had no fucking clue that Roaring Kitty was Deep Fucking Value until his Christmas Day unveil. He, in the conversations, never made it seem as though he were that individual. So it was a surprise to me, as I noted in the January Odd Lots recording from last January. I think it was a surprise to everybody. I never saw anyone on the stream say, I think you are he. I think I saw one or two people after the fact say they weren't that surprised. And then, sorry, what was the second part?
Yes, so first of all, yeah, I figured that no one knew that he was Deep Fucking Value, but did no one ever like question on the stream, like, hey, there's this guy, he keeps posting his GME YOLO, like, who is he?
Yeah, it was brought up.
Okay, okay.
Never, acknowledged
Right,
it was him,
okay.
or yeah.
Okay, I get it. And yeah, the second question was just, will this recorded talk be posted somewhere?
Yes. So we held a preceding episode of the Wookend. Our pilot episode was with a AGC at a public company. We discussed shareholder activism. Unfortunately, the way Twitter works is these spaces stay up for about 30 days. You have to download your archive. It comes in a .ts file. So I do have the file for the first one. I have yet to publicize it, but I will make the first one available. This recording will be available for 30 days on Twitter, and I will also publicize an accessible link after we figure out how to convert it to a better file type. So, yes.
All right, great. Thanks, guys.
Just, this is a little bit unprompted, but this is not a DD that I'm about to share, but just my general sort of thesis and how things are going out there. So it's clear that the strangest thing is that the same people who said don't fight the Fed in 2020 and 2021 are are doing exactly that right now. When I just sort of look what's happening on Wall Street Bets and in general among retailers, to not fight the Fed at this point in time means to not be long. Now, the Fed doesn't want a crash to happen right away because it's going to take some time for them to fix the inflation problem. And the farther down the market goes, the harder of a time they're going to have to do what they need to do, which is pull money out of the market. We're talking about $100 billion a month in duration that the market needs to absorb over the next 3 years, likely. There's also the 10-year yield is currently, in my mind, depressed and not as high as it should be because of what Japan is doing on their side and yield curve control, and sort of the ongoing trade of shorting JGB to buy 10-year bonds and putting a hedge on the Japanese yen to US dollar currency. So I think yields are actually much lower than they need to be. And so if they go up another % or two, you're going to see cash flow placed valuation models be much more bearish on the market. And if you look back at 2020, when the Fed decided to sort of step in and say we're going to save the market didn't immediately climb to 400 or 450 in one shot. It was basically a steady climb up. And the reason for that is that flows and funds have to come from somewhere. So things take time. The other side of the efficient market hypothesis that I've realized was wrong is that flows take time. And when you have a massive macro change like that the Fed stepping in to say we're going to save the market, or in this case, the Fed stepping in to say we're going to drive a recession, the flows for the market to adapt to that take a lot of time. I don't think the sell is done in 4 months, and I don't think it'll be done in 6 months. I don't know where it's going to end up, but it's probably going to be lower than here. And I think just as we saw on the way up, where when you're going on the way up, you saw individual stocks get well beyond reasonable valuations. You had video chat companies going to valuations greater than Goldman Sachs. On the way down, you're going to see the reverse, where valuations are going to get cheap, and then they're going to get cheaper, and then they're going to get cheaper. So it's not a bad idea to sort of keep some cash and sort of DCA into the names you like, but you should expect to lose on those as you sort of DCA. And it's going to be really hard to catch the bottom, but I don't see the urgency to really go along anything right now. If you're talking about any sort of trade that's longer than a few days, given what's going to be coming around in the next few months in terms of the general macro environment. That's just my 2 cents on things, and why my absolute largest position that I'm actively managing is cash.
All right. Lots of bear porn in there. So other questions for the panel from
I have a question about that, because I think he put an interesting thought out there about the interplay between short JGBs and buying treasuries. And that's something that's been going on throughout the bull market as well. And since the Bank of Japan has been more accommodative than the Fed for a long time, do you see a situation where that flow reverses at all?
Well, when you see that reverse, it'll be when the governor of the Fed decides to stop doing yield curve control. And when you see that happen, run for the hills, basically.
Yeah, good bear porn.
All right, I've got Nordic Ape.
All right, hello, Ozzy guys. It's been nice time hearing your stories and your opinions from, especially right now, if not all, but most of the GMEDD.com team members are here. Around the last November 2021, you guys released a report with the bull thesis of $1,069 by 2023. What do you guys think? Do you have the same thesis, or have you had changed? And what changes it at this point?
Sure.
And if, without giving any financial advice, what do you think is your new revised price target for the same period for 2023?
Sure, yeah, that report was put out, unfortunately, right around peak market valuations, peak multiples. It was the best attempt to quantify what we expected was an imminent launch of their marketplace, which hasn't yet launched. Multiples have gotten sliced more than in half. So that price is, as with any analysis, a snapshot in time. It was done using peer multiples. It was done trying to assess what the likely value of an NFT related cash flows and growth would be. I know Alpha Hound, I'm happy to have him chime in. He, Chris Vestro on the GMEDD team, myself, Joe and Jenna kind of all worked on taking our best stab at things. But suffice to say that it's massively reduced from that level, and it's a function of multiples getting massively compressed and them not launching the product. And the reality is the operating business has deteriorated more than expected. So it's meaningfully lower. And again, no one knows the future. You're trying to paint the best picture possible with the known information you have at your hands. So I think I would let Alpha, expound on that in any way. But by and large, the price right now is pretty reasonable if you think that they're going to have success with a marketplace and that these multiples are going to be realized. The current multiples are going to stay consistent, but they could go down, as Fat Aspiration has noted. Things usually swing further. The pendulum usually goes too far in one direction. So it obviously went too far when it went up, and it very well could go too far going down. We'll see what happens.
Yeah, and what I would encourage, if you want to check what the price today would be, the model includes the peers that GameStop was compared against and what their price sales multiples were when the model was published. You could go and look up those new values and just plug them in and see what the new output is. And I mean, obviously there's some other things that need to be amended. Like Rod noted, the revenue for the marketplace would need to be pushed back a couple of quarters. But the multiple compression, hard to overstate how bad that's been in the really speculative Web3 names. Like Roblox is down to 20 and change a share from 120.
Yeah, I think that hits the nail on the head. I mean, we put the report out in November, right? And you got to think that most of the high growth, high long duration, highly speculative, right? Because anything in crypto and NFT and Web3 is inherently highly speculative. Stuff has gotten absolutely decimated, 80+% down for many things. So the model is open source. You can go in, you can plug in your own numbers. But I think just given that on its face, it does sound like a value, a bull case value of 200 is probably, even closer to maybe our original bull case, right? Is probably a kind of a best case currently. But again, that's a knock everything out of the park. So a base case is going to be much lower than that. And then a bear case, of course, will be even further below. So nothing's a sure thing in financial markets. And it could very easily get cut in half, and a lot of folks would still think the thing is very overvalued. And they've got a lot to prove. They claim they're very long-term oriented and continue to say, look at their top-line results. But in the interim, they're consuming cash. Their margins have weakened. So it's very easy to make a bear argument about GameStop at 90 whatever dollars per share it closed at today. And yes, anything that was published amid peak multiples is very dated, even if it doesn't feel that old.
All right, thanks, guys.
You're welcome. All right, it's about top of the hour, so we've gone almost 2 hours now, and I really appreciate the speakers for sticking around. I'm happy to welcome, a couple more questions before we close this thing up. Again, the recording will be available on Twitter. We'll make it available after the fact on another venue that I'll publicize, or the Wook Capital Twitter will publicize. If you are not following Wook Capital, please do. Please also sign up for the newsletter to ensure that you're getting all of our communications. As I led off at the start, we have a lot of plans for social research is core to our thesis. This idea that all of these perspectives can together, get to a better understanding of reality, the pursuit of truth. That's something John and I hold dear. If we're wrong, we'll own that. But we're just trying to find the right answer. And sometimes it's not the one you want, but that's our goal. We really sincerely appreciate feedback. We're trying to look, this is our second go with this. We're trying to get better every day. I've never been a podcast host or space. I've hosted a couple of these things, but this is not a muscle. It's second nature for me. So please share any feedback with us. You can DM me. You can DM Wook. You can also go back to the survey we posted on a month or so back. So yes, with that said, I'll welcome last couple questions before we wrap up today. Goofy Goobler, you're up, sir.
Hello, everybody. Wow, I didn't realize I'd be up here, but really appreciate all of the thoughts. I'm humbled to even be listening to the call. I just wanted some thoughts. I'm definitely nowhere near as versed in things as almost all the speakers here. What are some thoughts, if you would share, on what you think the intentions of the vote for raising the cap of available shares to 1 billion and hinting at a forward split? I know that there's no concrete vote as of yet. It's only been hinted at. And if there's any thoughts on that, or if I missed any thoughts on that, I would appreciate it. Thank you so much.
Yeah, I'll take that one first, and then welcome for others to respond. So you got to think about, what is a stock split, a share dividend? What does that actually mean? You're basically just taking equity, the pie that is equity, and you're cutting it up in a different way. The pie doesn't get larger or smaller. The balance sheet effect is negligible. There's some accounting nuance between a stock split and a shared dividend, but for all intents and purposes, the outcome is no change. Now, that doesn't mean that psychologically there won't be impacts, right? If you're, let's say you do a 5-for-1 and now you go from $100 per share to 20, obviously in this market, there's a lot of retail participation, as we've discussed, and that $20 on its face looks cheaper than the $100, even though it hasn't changed the equity equation whatsoever. And you may have some buying activity from people who now think, oh, it's cheaper. You may have easier access to trade stock options. So whether it's people can now write covered calls or buy long calls or puts, I would expect there to be increased volatility because you would see larger trading activity in the security, but there's no short squeeze thing that's going to happen as a result of there being a share dividend. There's no share recall event. Those of us who were in GameStop a long time ago, it's over 2 years at this point, may remember, Dimitri, I'm sure, remembers this. There was a proxy fight in 2020 where the price was about, let's call it $3 per share. And all of a sudden there was this short squeeze where people who owned the stock but wanted to be able to vote in the proxy needed to recall their shares to vote for the proxy. Well, you know what happened? Even though there was this vote for 2 new board members of the company, 1/3 of the shares remained lent out, or rather the long holders did not vote. The Vanguards, the BlackRocks, the Fidelities of the world kept their shares out on loan because they made a decision that the lending income, the annualized borrow fee, got over 200% at that point in time. They made a decision that that was the right thing for their funds, their indices. They would generate more return, and it was the right decision to keep the shares on loan than to recall them and vote. And if they're not willing to recall shares to vote on decisions that actually impact the company, there's no reason to think that they will recall shares in something as as simple as a share split, to authorize more share issuance. So I would just compare those two and say there's no reason to expect anything to happen, in my opinion, other than what I noted.
Yeah, I appreciate that response a lot. Thank you. Yeah, not from a perspective of any squeeze or anything, just in terms of, yeah, I appreciate that. And when they did issue that initial release of they're hinting at any future split or forward split in the future. That was at a much higher price and valuation for the company. Given now that it's completely different environment and different price, do you think that they might reconsider or change the course of their action with that? And thank you so much again. Really appreciate it.
I don't think that they will shelve it just because the price declined.
Yeah, I mean, they can always authorize the shares and just keep them in treasury and not actually split the stock. Having the approval from the shareholders just gives them more flexibility down the line should conditions change.
Yeah, really appreciate it. Yeah, that was about all my questions. I'm gonna step down now. Thank you guys so much. Have a great weekend.
Thank you. All right, I've got a couple other speakers that have requested, so I'm gonna get to GA Blackburn. I'm gonna get to Uncle Cletus, and then we're gonna wrap. So last two.
Good afternoon, y'all. First thing, Rod, Playboy, my January calls. Give me some faith about Playboy. What do you think's gonna like with the market conditions that we're in now? Like, where do you see what do you think is going to happen with Playboy over the next 6 months to a year? What's your view on it?
Well, I think the reality is 6 months to a year is inherently too short to have any great insight. I could throw out a random ass guess, but it would be no better than anyone else's. My view on the stock remains that you have a unique a brand that's quite irreplaceable. It would cost many billions of dollars to recreate 7 decades worth of content and awareness for a consumer lifestyle brand like Playboy. And I broadly think that they are pursuing the right strategy to bring dollars onto their income statement through the growth of direct to consumer. The survey data that I continue to see is very strong for this 18 to 25-year-old and under 35 kind of targeted demographic. But there's no way to know if there will be a collapse in consumer spending in the back half of the year as student loan payments come back into play. Will that be a headwind? They obviously have a lot of initiatives that they are working on. The Wook Capital account, of course, tweeted in late 2021 that we became long. So Wook is, as well as I am, and it's been painful. And drawdowns are a function of investing. You experience Warren Buffett, I think, said it. If you're not willing to experience a 50% drawdown, you shouldn't be in the market at all, and something to that extent. But it's just the reality of investing. I think right now, I had made a comment that I thought personally, not on behalf of Wook or anyone else, that I personally thought that January 24 leaps were looking attractive. But even then, any call option is inherently leveraged and has higher risk than the equity. Your equity isn't going to go away other than dilution, which share-based comp's been elevated for Playboy. But I would argue the brand is quite healthy. All of the consumer data and the fact that their revenue has beat every single quarter is a positive. They need to become more cost conscious. Clearly, the market has no patience for companies that are burning money. But it's another one of those complicated situations where you ask someone, what is Playboy? And most people's response is, oh, they're a dead magazine company. So I think there's severe misunderstanding of what the business actually is. And there's also a lot of ugliness and noise on their backward-looking financial statements due to the M&A activity. So it's one of those misunderstood, mispriced, in my opinion, companies that, look, the future I think is quite bright, and I do believe it will be worth many multiples of its current valuation, but I couldn't tell you when that's going to happen. And I would say you just need to keep watching, keep monitoring the quarterly results, continue to look, try to read between the lines of what's going on social media, conduct your own due diligence, et cetera, et cetera. But to your question of where's it going to be in 6 to 12 months, man, I don't effing know. I sure hope it's higher, but it very well could go lower. But I would note that at this current enterprise value, it's trading at a meaningful discount to what the enterprise was taken private for more than a decade ago when it was a money-losing media business. So take that with a grain of salt.
No, I appreciate that because oh God, I'm like, I don't know, 80 I think my cost average on some $30 January calls is like $3 and change. And I'm not going to sell them because right now it's like I'm so down on it. I might as well just view them as lottery tickets. But it's been, I've been looking at with as cheap as the stock is now, you know, trying to do the cost benefit analysis of just saying, screw it, let's just start slowly accruing some shares, or, looking at longer leaps, like way further out leaps than what are out there now. Because I mean, hell, when a call costs almost as much as what the current share price is. And the other thing I wanted to comment, just to counter the GME bears, is that with GameStop, one of the things that makes me, I've got close, or hell, I think at this point I've got almost 500 shares. I've reinvested a large percentage of what I made back in January 21 back into the stock, and now I own God, twice as many shares as I had originally. One of the things that just makes me sit there and buy 1 or 2 shares a week, damn the cost, is the fact that, hell, there's 10 million shares have been DRS'd. It's GameStop has more of a cult mentality than Tesla, where I don't really care, hey, if it drops down to $40 a share, then hell, I'm buying 5, 6, 7, 8, 9, 10 shares a week instead. And that's the main thing that gives me no sweat off my back, and don't really care about the share price, and have no concern about, where it's going next week or the month after, is the fact that the cult mentality behind GameStop is even more bizarre than with Tesla. And that's, I view it as a 10-year or longer hold for me at this point. Now, although, hey, if it shoots up to, $400, $500, $600 a share, boom, I'm out.
Yeah,
Really
so your
scared of
thesis
me.
is
Wish you all the best, man.
so just to make sure I understand, your thesis is I'm going to buy shares no matter the price because there's a bizarre cult.
Well, no, I mean, hey, I'm not going to be buying GameStop at $400 a share. I'm going to be selling it at $400 a share. But, like at current price now, under $100 a share, hey, I've bought 3 shares this week, maybe 4 shares this week.
So here's the problem. Here's the problem, right? Like, you're not the only one who's me selling at 400 a share. There'll be a lot of people selling at 400 a share that never had shares to begin with. I will sell at $400 a share, and I don't have any shares. So it is the most attractive short above $200 a share out there because of how crowded this trade is. I don't think anyone who currently is part of this cult realizes that their exit plan is going to be front run by every single short seller out there, and they're not going to have the opportunity to exit at the price they think they want to.
Yeah, I would have to concur a lot with what Fat had to say, and I'll let other people respond. But Bill Gross has made it public knowledge that anytime GameStop gets up over 2 or toward 3, he's massive, and he has been banking off of it. He's been selling naked calls. And look, sometimes you'll get punched in the face when these crazy rips happen, but the reality is many of the longs are just looking to get out from underneath these heavy bags they're holding. They may claim that they're going to hold to the moon, or whatever the moon means, or 10 million per share, whatever that means, that the equity will be worth more than the GDP of the entire world. Who knows? But unfortunately, it's just a lot of really bad information. It's leading to, I think, a lot of bad decision making. And look, I'm
by the way,
willing to admit that I could be wrong, but yeah, it's a sad situation.
I'm not trying to attack your position to attack you. A part of me is, feels a little responsible for, this cult, that has happened, and I don't think it's going to play out well. And if I could save anyone a future misfortune, I would love to do that. Just media. I don't think your plan's going to work, and it's okay if you want to continue doing it. But I hope you're doing it with money you don't need. And if you're doing it with money, you're just dropping into an infinite well. Good luck. But there are plenty of people who are taking the other side of the trade when it gets to the point where you're planning to exit. Just be really careful with your thesis on exiting. If you're buying at 80 or 90 because you think it might pop to 110, that seems very reasonable. I mean, I would play Jamie swing into double digits, and I've said this before on my Twitter. But I'm waiting for it to go well below 80 before I consider actually getting long shares. And in the meantime, I have no problem, selling puts at like a 5% monthly interest rate or whatever. That's the kind of way I've been able to consistently earn on GME. But I'd be very careful if you're playing the MOAS thesis. Remember that it's the most watched, meme ticker out there. Like you said, it's got this amazing following. So what is going to happen as soon as it crosses 200? Every single person out there is going to short it. It is not a hard to borrow stock. You can short it. And that liquidity being low because of all these shares locked up means as soon as that happens, the price is going to shoot back down. So it's just not going to hold high levels for very long, right? So just be careful.
And I don't buy the MOAS theory either. I mean, I think that happened in January of 2021, when it shot from, what was it? What was it at, January 2, with January 3, it was $18 a share, $20 a share. And in less than 4 weeks, it shot up to, I know I sold 50 shares at $493. So I mean, I understand that I think it's just, there's such a cult mentality like Tesla, and so for me, like GameStop, I mean, hey, if it shot up to $300 a share, $400 a share next week, hey, I'm out. But it's, I view it as hey, you know what, 5 years, 10 years from now, is it going to be, is
It's not
GameStop going
going
to be
to, because I'm going to short
no,
7
but
figures of JME if it gets there.
a $50 billion company, it could be.
It could be a zero in 5 years.
Well, yeah, I mean,
I
hey,
don't say that disparagingly, but
so
think
could
right now
Tesla.
there's no
I mean,
there's no visibility for any company in this market.
All right, very good. So not to look, I would love to keep this going. But I want to be respectful of everyone's time, and I'm going to let Uncle Cletus get the last question in before we wrap. If somebody wants to set up another spaces to kind of keep this sort of conversation going, by all means, welcome that. I know personally, I'm going to go have myself an alcoholic beverage when we get done. But Uncle Cletus, please go ahead.
Hey, man, I'm drinking one for you right now, Rod. I've been following you guys for a long time. Probably the last time I saw one of your plays was Dole Bananas. Didn't hold long enough, but anyway, a little bit of a squeeze. Really, man, I just wanted to get on here and just ask about Wook Capital. I don't know how you guys want to pronounce it. But I kind of just wanted to ask, what are your ideas on this moving forward? Like, is this a service or is this more just like DD? I mean, what's the plan moving forward? I haven't really researched too much other than the website.
No, thank you so much for the question. And I really think it's a great one to go out on. So, John, I'd love to ask you to chime in if I miss anything. But, we all, the folks who were on the speakership, the GME hedgehogs, look, we all saw the value of very diverse perspectives, really just bright people who may not have had a lick of professional financial services experience. I don't think anyone who was in the GME hedgehog server had worked on Wall Street or had professionally managed assets. So it's one of those things where we saw that you don't need to have that background to successfully conduct research to analyze financials, to do that really extensive research that we did, right? If you may remember, I uncovered that GameStop.com order numbers were sequential at one point in late 2020, and basically backed into a financial model of what the company's operating results would look like by crowdsourcing that research. Have uncovered that for several other securities, some interesting nuggets of information that I don't believe the market is aware of. So I think that in essence, we saw and we lived this experience that, like Fat Aspirations was noting, the efficient markets hypothesis is bobo. It's not real. But you should look in places where other people are not looking, and you should encourage other people to look. And when a lot of people start looking at something that hasn't been looked at, you're likely to uncover things that were missed and are being missed, and identify interesting opportunities and develop interesting theses. And Dimitri made the point of this idea of the cotton candy getting better and better as you wrap different flavors in. And I think our goal with Wook is to recreate that at scale, is to build this social community where enthusiastic investors can come together. You don't have to have a professional background. You don't need to know much. Look, if you don't have anything to bring to the conversation, you can still benefit from it. We, of course, want to welcome experts who have unique insights and expertise to whether it's tech or oil and gas or whatever industry du jour it is, so that we can build better theses. But we're not trying to get somebody to sign up for some monthly service. There's zero intent for that. John is fortunate in that he owned, more than 1% of the company of GameStop going into January of 2021. He obviously had that wonderful discussion with Cohen that we talked about, and it's enabled us, him to found this private investment fund that I'm working for him with, and that we're just starting to really explore this idea of scaling that novel thesis, that crowdsourced research you can reap alpha out of. And look, we're looking to do this for years to come. It's going to be a tough market. I think, like Fat Aspirations is validly noted, you've got QT and you've got a lot of macro headwinds, and it's going to be a rough ride. That doesn't mean there aren't investment opportunities out there. So Wook is looking to build an investment community. We're not looking to sell you a damn thing, but really welcome anybody into the mix. We have a lot more to come. We actually had a meeting last night with, I know Joe had to drop, but we were talking with Joe just to try and understand, what are some of the social opportunities. But that's our goal. We want to help educate people. We want to provide access to institutional grade research because we have the assets to do that for small retail investors. So we're all looking to learn together, get better together, and try and kind of see if we can experience what was done with this GameStop group and see if that can be done at scale repeatedly. So John, I'm going to let you wrap, and if you had anything to add to what I just said.
No, I think that's the crux of it. I mean, the belief is that in a world where information just travels so fast and pretty much freely, and you can look anything up on the internet, I think it's become much more difficult to find any edge over the market, or any stock or ticker really. And but as Rod mentioned, the crux of it's dependent on the fact that when the community can come together and everybody offers their own expertise and insights, as we clearly saw with the whole GameStop saga, I think that could be a viable and consistent route into building thesis with actual conviction that we can continue to play on. I don't think it's possible to really do it alone anymore. Everything is priced in too quick, processed too fast, and so the basic idea is that we have to rely on each other. And so when it comes to Wook, we plan to be a lot more social, have these discussions, form a community, but then eventually get to a place where there's a scalable path or system for everybody to work on these ideas together. And I really don't think investing is a zero-sum game where someone has to win or lose. But in that, if people work together like they're doing today, everybody can win. And then we want to make sure that happens. It's never been tried. I think it's a novel idea, leveraging social media as a fund. So we don't even know if it's going to work for sure. But I think we're in a good position to try.
And the one thing I would add is that we're we're not talking about like short-term trades. We're genuinely talking about identifying multi-year, multi-bag type investment opportunities. So, don't think this is just us saying, yeah, let's, skim social chatter and, buy a bunch of call options on this company. We're talking about bottom up, thorough, crowdsourced due diligence to identify, the next Amazons, the next Googles. Obviously, that's a stretch, right? But those companies start small and they start undercovered, underfollowed. And yeah, it remains to be seen if this thesis can be proven. But we have the capital, we have the conviction, we are going to do our damnedest. And there's a lot more to come over 2022 and beyond from Wook. So we sincerely appreciate everybody tuning in today. I hope that you found this a valuable use of your Friday afternoon. The recording will be available. And please sign up, follow Wook, sign up for our newsletter. And as I said, there is plenty more to come. We are in the midst of, starting to get ready for hiring later this year more. So thank you, everybody, again. Thank you to our panelists, to our hedgehogs. Guys, it was great to catch up with many of you. And I hope everybody has a great rest of their day and has a nice weekend. Cheers, everybody.
Cheers.